Good afternoon, I'm Matt Stevenson of RBC Insurance. Welcome to today's Oakville Chamber of Commerce live stream lunch. Today we're talking about creditor insurance, how it compares to term life insurance. We'll talk a little bit about permanent insurance at the end. So straight into it now on the creditor insurance. This is the scenario if you're purchasing a home, taking out a mortgage, the creditor insurance will pay off that mortgage if you pass away. So this is very quick, easy, and accessible. It's convenient. And it's minimal on medical underwriting. You basically have to decide if you want it or not when you're getting into that mortgage. So some scenarios in real life about how this actually works is if an individual purchases that home, takes out that mortgage, and then gets the creditor coverage. They pass away. Now their estate will own the home and no money on it. No money owing because the creditor coverage will have paid off that mortgage. Now, if this person has beneficiaries, then the home will be in their estate, probate process will happen, and ultimately the beneficiaries will be able to sell the home and get their inheritance that way. Now, what if we have the scenario of a husband and wife with some young kids buying the big family home and taking out a big mortgage? They get that creditor coverage on both of their lives. Now, if heaven forbid one of them passes away, now the surviving spouse will still own the home, kids will still be in the house, the mortgage will be paid off. So there will be financial relief coming to the situation at the time that it is needed. And again, it's quick, easy, convenient, it's cost effective compared to permanent insurance, and it's a way of looking after the financial risk. Now turning to term life insurance, this is something actually entirely different. It's not tied to your mortgage specifically at all. When you take out a term life insurance policy, you're deciding two things. One, how much coverage. There's inflexibility on terms of creditor insurance. Your coverage amount tends to be your mortgage balance. No higher than that, no lower than that. But on the term life insurance, you get to choose actually how much coverage you're going to take for yourself. And this, a lot of times, is going to be more than actually your mortgage balance because there's going to be more to be paid for. The second thing that we're deciding is the length of your term. How long do you want to insure yourself for? This can be as short as a couple of years, 10 years, anywhere up to 40 years. Again, it depends on the individual or the couple and their circumstances. So term life insurance offers a whole lot of flexibility. Now let's go back to those scenarios where we have, firstly, the individual buys a home, has a mortgage. They don't take the creditor, they take out term life insurance. Now if this person passes away, now their home will be in their estate again, but the money will be owing on it because there was no creditor coverage. But their beneficiaries are going to receive a check payable to their own name within 30 days of their passing from the term life insurance. So on the one hand, if they use the creditor, they'll go through their estate, probate process will happen, beneficiaries will receive their inheritance after some time. On the term life insurance side, the beneficiaries are going to receive in cash in their own name within 30 days. They're just going to like that more, reasonably speaking. Now, in the scenario of the husband and wife with young kids, taking out term life insurance to protect against the financial risk, this is where it becomes very interesting because once one of the spouses passes away, going forward there's going to be something very important missing. It's going to be the income of the now deceased spouse. So on the creditor side, where we have inflexibility, the mortgage gets paid off, and now we don't have that missing spouse's income coming in the door anymore. While yes, there is relief to the financial situation that there aren't mortgage payments anymore, there is now additional expense taking its place in terms of looking after the kids. Now this is going to be more expensive than it was before because you're missing one of the parents who was helping to look after the kids. And that's going to cost you going forward. So, the term life insurance is going to influx cash to the surviving spouse. And again, that's coming in at the time that it is most needed. And there will be that flexibility there. The surviving spouse is going to have this large sum of cash that they can make their annual mortgage prepayments with. They can opt to pay off the mortgage with it. They can invest that money, start receiving dividends and interest into the household, use that income to make the mortgage payments. Again, there's the flexibility. So on the creditor side, first thing that'll happen to replace that lost income is the surviving spouse will take out a home equity line of credit and start spending that received money back out to replace the lost income. Now, once we're replacing lost income with borrowed money, that's a concern because ultimately you won't have a way of paying it back. If we replace that lost income with an influx of cash from the term life insurance, that's going to look after things a whole lot better. In the long run, if you've done a proper plan with a proficient insurance advisor who sets you up with the right coverage amount for the right length of time, things will work out better. Now let's talk about permanent insurance very briefly. This is something entirely different once again from both creditor and term coverage. Permanent insurance is a wealth management tool. It's an asset class. You can think of it as something similar to stocks and bonds and real estate. It's something that someone interested in a proficient financial plan is definitely going to want to have in their portfolio. The way it works is this. Let's go back to term briefly. If you ask the insurance company when they're providing a term life insurance policy to someone, ask the insurance company, do we expect to cut that death benefit check someday? Insurance company will say, no, we don't think we're going to. We expect the life insured to outlive the term. Now, on the permanent side, ask the same question to the insurance company. Are we going to be cutting that death benefit check? Insurance company will say, yes, we are. We just don't know when. It's a guaranteed thing. We'll collect the premiums. Once the person passes away, we pay out. So this is why permanent insurance is a little bit more expensive than term insurance, because if we're agreeing to pay out $1 million to someone's estate or their beneficiaries once they pass away, we need a financial basis inbound to the insurance company in order to be able to do that, to be able to cut that big check. So this is why it's a great wealth management tool. The permanent insurance can be used for estate planning. It can be used to pay estate taxes. When you anticipate that you're going to have taxes owing on capital property once you pass away, then the permanent insurance is there at the right time once again to pay those taxes. It's a legacy tool in a lot of cases. There are a couple of other uses that we won't get into today that become a little bit technical, such as the ability to spend your own life insurance essentially while you're still around using permanent insurance, which is an interesting thing, as well as for incorporated business owners to get money out of their corporations without paying personal tax rates to do so. Very interesting and compelling topic for another day. But to summarize the permanent insurance, the sum of premiums paid into the permanent policy will always be substantially less than the death benefit. That's why it's an asset class, should be in your portfolio. It's gonna make your family money. Again, get with a proficient advisor, get your plan going. So now to summarize the talk, we've got the creditor coverage, which looks after financial risk. Quick, easy, accessible, modest on premiums. You can use it. We've got the term life insurance, which provides a lot of flexibility at the same range of premium cost as the creditor coverage. Very interesting to take a look at, particularly if you're a husband and wife scenario that has kids and a big mortgage. Very effective use to look after the financial risk. And finally, the permanent insurance, which has the higher premiums, but with good reason. As we're saying, that check is going out someday. Thank you so very much. Appreciate you watching. Hope you learned something and enjoy the summer.